The Nasdaq market is currently closed, with SoFi Technologies Inc. (SoFi) stock having closed the last trading session on Friday, September 26, 2025, at a price of $27.98, marking an intraday movement of minus 0.50% from the open. Now, the surface-level narrative surrounding SoFi, which most retail investors and those following online chatter believe, is centered on its status as a fintech growth stock that successfully transitioned from a specialized student loan refinancing platform into a fully-fledged digital bank. The general expectation is that its massive member growth, now exceeding 11 million, and its highly visible CEO, Anthony Noto, are the core drivers of its impressive run-up over the past year. However, a much more intricate and financially compelling development that is often missed in the quick-take analysis is the massive and accelerating shift in its revenue mix. The real story isn't just that they have a bank charter or that they are adding members at a robust clip, but that the high-margin, fee-based revenue is growing at a significantly faster rate than the core lending business. In their most recent quarterly report, the fee-based revenue surged by an astonishing 72% year-over-year, which is the unexpected anchor that is creating a durable pathway to sustainable, high-quality profitability, fundamentally challenging the view that this is just a lending stock. This reality creates a far more insulated and promising financial profile than the market is typically pricing in, where the focus remains largely on the lending segment, which is inherently more sensitive to the macroeconomic environment. The common ground for almost everyone tracking SoFi stock is the consistent and aggressive expansion of its financial super app concept. The company's goal, as a modern alternative to traditional institutions, is to be the one-stop shop for an individual's entire financial life, from managing checking and savings to personal loans, mortgages, online investment options, and even credit cards and crypto. This model relies heavily on cross-selling, a strategy where a new customer brought in through a low-cost channel, perhaps a free savings account or an initial personal loan, is then migrated to other, more profitable products, like SoFi Invest, which includes options for self-investing and features like Schwab Intelligent Portfolio-style robo-advising or the SoFi Active Investing platform for individual brokerage. This cross-pollination is where the operating leverage truly begins to shine. Every new product adopted by an existing member drastically lowers the effective customer acquisition cost, which is a key metric in the highly competitive fintech landscape, where rivals like Robinhood, Fidelity, Interactive Brokers, and even the established commercial banks are all fighting for the same digitally native customer. But here is where the deeper reality begins to challenge that common belief. While the lending business, personal loans, student loans, and home loans, remains the largest revenue contributor, generating significant net interest income, its growth is inherently tied to interest rate cycles and the credit health of the consumer. The contrarian view suggests that the market's enthusiasm is still disproportionately focused on this lending volume, which can lead to volatility. When you look closer at the institutional activity, there's a mixed picture, with some large hedge funds and institutional players like ARK Investment Management significantly reducing their positions in earlier quarters, while others, such as Bank of America, have added substantial amounts. This divergence highlights the debate. Are the institutional players focusing on the lending risk in high-interest environment, or are they modeling the non-lending growth? The latter camp, which is arguably seeing the bigger picture, is likely focused on the Galileo and thesis technology platforms. The Galileo platform, which SoFi acquired, is a key piece of the puzzle that many investors simply gloss over or underestimate. Galileo is a technology infrastructure provider that powers the core services for other fintech firms. It handles payment processing, account setup, and fraud prevention for countless other companies, essentially selling the digital picks and shovels to the entire fintech realm, including competitors. The thesis acquisition, which provides a modern cloud-native core banking platform, solidifies this technology segment. The financial services and technology platform segments, which are predominantly the non-lending fee-based part of the business, are the true operational differentiator. They are high-margin, highly scalable, and importantly, they are counter-cyclical to some extent compared to the lending segment. When the macro environment gets tough and loan demand dips, these fee-generating technology segments provide a vital revenue floor and continued growth engine. This is the part of the business that allows SoFi to act less like a traditional bank exposed to credit cycles and more like a high-growth software-as-a-service company. It offers a level of operational diversification that neither Robinhood or even a larger traditional player like Fidelity Investments can easily replicate in-house. The recent stock movement has been a textbook example of this tension between expectations and reality. We've seen a powerful run that peaked near the 52-week high of $30.30, driven by the consistently strong earnings reports, where the company repeatedly posted GAAP profitability, now for multiple consecutive quarters, and aggressively raised its forward guidance for both adjusted net revenue and EPS. That's the reality exceeding expectations. However, in the days leading up to the recent close, we saw a slight correction, where the stock pulled back from those highs, closing lower at $27.98. This recent weakness can be attributed to profit-taking after the substantial gains and a typical market nervousness about valuation multiples for high-growth tech firms. The PE ratio is undeniably high, reflecting the market's belief in massive future growth. When the general market narrative says the stock is up because of lending, any slight worry about economic slowdown or credit quality can trigger a sell-off, even if the underlying technology and fee-based segments remain robust. It is this psychological swing that creates trading opportunities where the market momentarily forgets the high-margin diversification that Galileo brings to the table. In terms of the business model breakdown, the core operations are split into three main segments: lending, financial services, and technology platform. The lending segment, while sensitive to interest rates, is managed with a focus on high credit quality borrowers, as evidenced by the high average FICO scores and substantial average incomes of its personal loan customers. This disciplined approach is their buffer against broader credit risk. The financial services segment includes SoFi Invest, which is their equivalent to the various online investment platforms. It includes self-directed trading, SoFi ETFs, and a form of intelligent portfolio offering, along with checking and savings accounts and credit cards. This is the segment focused on generating interchange fees, subscription fees for SoFi Plus, and brokerage fees. The fact that the contribution profit from the financial services segment more than doubled year over year in the last reported quarter is a powerful demonstration of this internal cross-selling machine working exactly as intended, moving closer to the model of a truly balanced digital financial institution. Looking ahead, the future outlook for SoFi is clearly focused on accelerating the non-lending side of the business while maintaining conservative growth in lending. The key catalysts are tied directly to the execution of this strategy. First, continued product innovation, such as the recent partnership to power blockchain-enabled international money transfers, or new AI-driven tools will keep member engagement high and support further cross-selling. Second, the growth of the Galileo platform through new external client wins is a pure-play software catalyst that has little to do with the interest rate environment. The market will be closely watching for new large contracts there. And third, and perhaps most critical, is the trajectory towards consolidated, enterprise-wide GAAP profitability. The fact that they have achieved it and continue to forecast higher is a huge vote of confidence. The risk, of course, remains tied to the macroeconomic picture. Any sustained rise in unemployment or a significant deterioration in the quality of consumer credit could force SoFi to increase its loan loss provisions, which would pressure the bottom line, regardless of how well the technology segments perform. The stock's correlation to general fintech and high-growth sector sentiment, often moving in lockstep with Robinhood, or even larger tech plays like Apple stock or Nvidia stock during broader market swings, also poses an external risk. The overall market's appetite for growth stocks determines the trading multiple, which is outside of SoFi's control. The major tension for investors is this: do you treat SoFi as a banking stock that is valued on book value and net interest margin, or as a high-growth technology platform valued on revenue multiples and subscriber growth? The reality is it's a blend of both, but its increasing reliance on fee-based revenue is pushing it firmly into the high-growth tech camp, which justifies the current premium valuation in the eyes of long-term holders. The company has a distinct advantage over legacy firms that operate using old, expensive core systems, which is the main selling point of Technesis. For all of you following this closely, comment below with what you think is the biggest long-term risk for SoFi: credit quality in the lending segment, or competition from established players like JP Morgan, or even a revitalized interactive brokers platform aggressively pursuing retail investors.
In summary, the expectation that SoFi Technologies Inc. is merely another volatile fintech with a good story about student loans is fundamentally undercut by the reality of its accelerating, high-margin fee-based revenue from its financial services and technology platforms. The company is successfully executing a long-term strategy of operational diversification and internal synergy, which is moving it away from the pure-play lending volatility of its past. While the high valuation reflects optimism and demands flawless execution, the verifiable growth in member count and cross-sold products, coupled with GAAP profitability, provides a much sturdier foundation than most general market observers acknowledge. The ability of the Galileo platform to essentially sell infrastructure to the competition further cements its unique positioning. Investors must recognize the duality of this business, the cyclical nature of lending, balanced by the consistent, sticky growth of its tech services, to accurately judge the future potential of SoFi stock. That internal balance is the enduring insight that separates the informed investor from the noise.